Good evening, ladies and gentlemen. The next step in our learning is going to be looking at bookkeeping. And bookkeeping is really about keeping records, and it's the first step in accounting for the performance and financial position of our business. And for our purposes, accounting can be defined as the process of recording, classifying, and reporting in monetary terms the transactions of a business. So we need to record the activities that happen in our business. We need to record the transactions into journals, and we can group those into transaction types. We then classify the totals from those journals into a ledger, and this information is then stored against each account. We then need to be able to report on that information using the balances of the ledger accounts to provide, say, end-of-year financial statements. So we're going to look at what a profit and loss statement is, or a balance sheet is, and what's the difference between them. So an accounting system can be described as an information system for our business. We input data about transactions during a period, we process it, and we produce some summary information that gives us information about the performance and financial position of our business. So some of the terms we've just mentioned we're going to look and describe in this upcoming section. So we're going to look at the flow that we use for bookkeeping. And some of the terms and some of the activities you've already started doing, we've got transactions that we're going to record. You might bill someone for work you've done. You might purchase goods and materials. They're all transactions that we have to record. And we use our source documents to record that information. So Adrian's already taken you through the invoices, maybe some receipts, checks, cash books, and so on. And Brett's taken you through how you will reconcile those. So we've already started putting them into some sort of a journal. So we've got sales journals, purchases, cash receipts and cash payments journals that we're going to look at. Then we look at ledgers. Ledgers are just summaries of different accounts where we've grouped our transactions into different activities. So we have accounts receivable, accounts payable, and so on. Then we'll do some trial balances, some summaries to see where we're up to, and some reconciliations to check the accuracy of those ledgers that we've been using. And from there we'll then produce some reports that are useful to us to be able to determine how our business is tracking financially. So we'll look at how we can do job cost reports, a revenue, or a profit and loss statement, or a balance sheet. Okay, so to give you an example of where we're doing, or what we're doing, I'll bring up just a quick spreadsheet. I'll bring up the spreadsheet, and I'll give you, this will be available to you later, this spreadsheet, but this is a development from your business plan. So you've created a 5-year forecast when you develop your business plan. When you start out and you say, what is it we're going to be doing? Well, then you have to think ahead and say, moving on from how we're going to develop, what sort of work you're going to do, and so on, you have to develop the financials for it. And we're going to look at balance sheets and profit and losses. And this is an example of a sample company set up where we're going to do a 5-year forecast, and we're going to list our assets, our liabilities, and our owner's equity. Okay, so they'll come into our balance sheet. And then we're going to look at our profit and loss for a period of time where we look at our revenues, our expenses, and our profit. And we're going to do this over 5 years forecast. And we're going to see how that changes over that time. We'll look also at what makes up our assets. What's a current and non-current asset? What's a current and non-current liability? Excuse me. And how do we end up with our owner's equity in our company, and what's its value to its owners? We'll look at some ratios that we can use to analyze our company against other companies or against standards, and say, what's the proprietary ratio, the owner's equity divided by its assets. We'll look at what percentage that is, current ratio, liquid ratio, and so on. And we'll get to those in the next couple of days. We'll also look at what makes up the revenue or the income into our business. What are our expenses in terms of direct expenses and indirect expenses. And then we'll look at our profit and how that transfers back to our profit balance sheet at the end of the year. Now, before we can develop this financial plan, we need to do a cash flow. And we're going to look at a company cash flow where we record our expenses and income, over the next 5 years. Okay, we're going to look at some sample jobs that we're going to take on, and we're going to plan that out, and we're going to do our cash flow for 5 years from now. Okay, so again, this is a quick overview. We're going to be going into more detail on these, but again, in our expenses, we're going to be looking at direct costs and our indirect costs and what that means, okay, and what sort of income we can expect. And this is going to depend on how you set your company up. But we can look at some sample projects. We'll take a look at some options and how that affects our cash flow, and we'll do our expenses, indirect, direct, and our income across a period of time. Now, before we can set up our cash flow for our company, we've got to look at the cash flow for each project. So we'll look at a typical house project that we're going to do, and we'll do a cash flow for that, and we'll look at whether that's for our internal company doing it ourselves as a project, and of course we have expenses that occur over time, and then we get paid at the end when we sell the project if we're doing it ourselves. Or if we're working for a client, we have expenses that occur, and then we have some, maybe a deposit, and then some progress payments that occur along the way. So we'll look at how that affects it, and then that gets transferred into our company cash flow. Okay. Now, before we even start the job, we have to do a feasibility. So we'll have a quick look at a feasibility study as well, and we'll look at, say, a simple dual lock, where we take a block of land and put a couple of houses on it and sell it off. So we can look at what our total cost is going to be, what that's made up of, what our revenue is going to be, what that's made up of, and what our anticipated profit's going to be. And we'll look at the details and the percentages for each of those. We'll look at a simple dual lock, then we'll have a look at maybe a more detailed project just to give you an idea, a unit development. We'll do a feasibility study quickly looking at that, and then we'll look at some finance options, how it comes to how much money do we have when we start our business, how much are we going to need, and what's our best option in terms of which projects to take on, how many to take on at once, how much money you have to invest in. Now, when you're starting, you may not have the monies we're talking here. I mean, let's take, for example, we have a simple job where we do a reno on a subdivision of an acreage. Well, it might cost us $420,000 to purchase a block. It might be $200,000 in expenses, so that's $620,000. We might sell it for $875 and make $255. Now that sounds like a good little profitable job. That might take us a couple of years, so we make about 20% on our money per year. Now, what happens if we don't have that money? Can we borrow that money? So we'll look at options of where we, put 20% down and maybe borrow 80%. Or another example might be that, you've got all these jobs lined up to do. Do you do them one after the other, or you do them all at once? If you do them all at once, you're looking at nearly $5 million in costs. Now, you're definitely not going to have $5 million when you start out, but later on you might look at an option of that. And you could look at smaller jobs, and we could divide this by 10, this amount, or by 100 when you're first starting out. And these just could be much smaller jobs. But just give you an example of how a builder will typically look, or a developer will look at how they're doing and their projects. So if we had, say, $1 million in cash to do some work with it, would we do 2 jobs and make a profit of, say, $380,000 in 2 years on those 2 jobs? And this is a gross profit. We've got to take out indirect expenses of running our business out of this. Or do we take that $1 million, for example, and say we could do all of these jobs if we put 20% cash down, do them all at once, and we'd make nearly $1.2 million. And that's leveraging, and that's using, I think, our option. So that's something else that we're going to have a look at when we come back. So we're going to get through each of those steps, and we're going to work our way through. And the next thing we're going to have a look at now is the ledger accounts, and we're going to say, okay, what's actually involved in these ledgers? What are these accounts? What's a profit and loss, and what's a balance sheet?